I'm Mike Aldridge with Mobius Risk Group, introducing SM Energy this morning. SM is a premier operator of top-tier assets who strongly believes their values, commitment to excellence, flexibility, and experience give them the edge and resilience to continue their long-term success. As a leader in the oil and natural gas industry, they are proud to provide resources that make people's lives better every day. Their strategy is to focus on high-quality, lower 48 oil and natural gas producing assets with top-tier economic drilling, completion, and production opportunities. At present, their investment portfolio is focused in 5 counties in the state of Texas, specifically the Midland Basin in West Texas and the Maverick Basin in South Texas. They seek to maximize and expand the value of their assets through application of the latest technologies and outstanding operational execution, with their employees being their most valuable asset. They seek to expand through the acquisition of top-tier acreage and continued delineation of current top-tier assets. Speaking for SM Energy today is their President and CEO, Herb Vogel. Herb?
Thanks, Mike. So good morning, everyone, and thank you for the opportunity to speak to another great audience at EnerCom on another beautiful Rocky Mountain day in Denver. I'm really excited to talk to you about SM Energy today. We have something really special going on at this company, and I'm really looking forward to sharing more of that with you. So let me go first to our disclaimers. I'll be making some forward-looking statements and point you to the disclaimers on slide 2. But let me start with some background for those of you who may be unfamiliar with SM Energy, or as Mike reminded me, heritage company St. Mary Land and Exploration from prior to 2010. We were founded in 1908 in Minnesota, headquartered right here in Denver since the early 1960s. We went public in 1992 and listed on the NYSE as SM in 2002. Our real start in oil and gas was in St. Mary Parish, Louisiana in the 1930s, and we have a long history of successfully navigating through the cycles in the industry. We now have a company that produces around 150,000 barrels equivalent a day, mostly from private lands in the state of Texas, and as Mike mentioned, from 5 counties really. And at year-end 2022, we had proved reserves of over 500 million barrels equivalent. So we've long talked about being a premier operator of top-tier assets, and what does that really mean? And it means we pride ourselves on capital efficiency and driving toward operating top-tier assets, meaning high return and low break-even assets that we can drill through the commodity price cycles. And part of being a premier operator is ESG leadership, and I'll talk quite a bit more about that later. What I'll do today is cover some of our latest materials from the second quarter results, cover the strength of our balance sheet, and then I'll get under the hood into what makes us a premier operator of top-tier assets. And I understand if I say that enough, premier operator of top-tier assets, you'll take that home as your memory of SM. So let's hope that's true. So let me get on with it. So if we look at the second quarter of 2023, it was actually quite critical. In June, we went over a lot of results that we could see. The quarter was doing quite well, and we doubled the number of shares we repurchased, and return of capital is one of the most important things that we're focused on in 2023, and we returned 92% of our free cash flow in the quarter to stockholders. On the operational side, we produced 14.1 million barrels equivalent, which was well above our guidance. And that really was because our South Texas Austin Chalk assets performance exceeded expectations by quite a margin. We had expanded our oil handling facilities, and that really cleared bottlenecks that had hindered us in the back end of 2022. And that enabled us to increase our full year guidance by 1 million barrels equivalent. Not only that, we did experience deflation, and were able to reduce our capital budget without a reduction in activity by about 50 million to $1.05 billion for the year. And then in terms of inventory, which is so critical, we also added 22,800 acres in the Midland Basin for about 91 million in leasehold acquisitions. So that's really what got us started, and we really stepped on the gas in the second quarter, and that enabled us to also talk about mid-single-digit growth into 2024, and that really means production growth and free cash flow growth. So looking at since inception, our return of capital program, which we announced last September, we've already bought 5.3 million shares of our 500 million commitment to buyback by year end of 2024, and a total return of 221 million, and that was 166 million in buybacks and 55 million in dividends paid. And you can see our quarterly dividend, and you'll see that word sustainable, and that's the critical thing. I'll get back to that in a bit here. And then the repurchases of the 2.6 million shares in the second quarter. Our balance sheet, very strong. We have nothing drawn on our revolver. You can see the maturities are laid out quite well, and we're trading at our target leverage area at 0.7, and we wanted to be below 1. And we're also set up that we really model ourselves at commodity prices down to 60 and 3, and having that sustainable balance sheet that enables a lot of the activities that I'll be talking about. And you can see our credit ratings there. So this is the slide that we show quite a bit about being sustainable and repeatable. And people say, well, what does that mean? It's really, when you're paying a dividend, you want to know that you're going to be paying that dividend quarter in, quarter out for years and years to come. And how do you do that in the E&P industry? So first of all, you got to have the assets and operate effectively. And we're doing that. That premier operator of top-tier assets, that means high capital efficiency. And then the top-tier assets means low break-even prices for our assets. If you look at it, the strong balance sheet enables everything we do. From a repeatable standpoint, and this is what I'm going to be digging into a bit more, is how do we replace inventory year in, year out? We've got a great track record there, and that's where our team really excels. So we're able to organically add inventory, and that differentiates us from some of the peer companies, and I'll show some more of that. And the important thing is getting that strategic inventory capture and growth, and by being able to continue to add inventory at the same time, paying the dividends and completing our buyback program is what drives the value in the company. And where our team really excels is knowing where to drill, which is so critical, and then executing well when we do. So again, I think you've heard this before, premier operator of top-tier assets. We'll just have to hit that one again. So this is one that I thank Zach Parham of J.P. Morgan. A quote from him is, our geoscience staff really stands out. We're a mid-cap company, but we've got a large-cap technical team, and it really means large-cap capability and more in terms of what our team is able to do. And I'm going to give you some examples that we've had success organically adding inventory through really the ability to understand the fundamental drivers in unconventional resource development. And that's really where our expertise is. So if I look here, and I'm going to spend some time on this slide, it's a difficult one to look at, but on the left is really before SM entered into a play, and on the right is where things were by the end of 2022. In terms of Howard County, which is in West Texas, before SM entry in 2015, so we did large acquisitions of 60,000 acres during 2016 in Howard County. At the time we came in there was only data from 79 horizontal wells, and there were only 3 reservoirs that were tested. Fast forward to 2022, we ramped up rig counts there first, and by end of 22, there were already 3,200 industry horizontal wells in Howard County. It was one of the busiest counties in West Texas, even though it's not one of the largest counties. 8 reservoirs had been tested, and we reported 12 years of inventory as of year-end 2021. So what happened between 2016 and 2022? So you start with limited data, not much activity in an area, people question the economics, there's uncertain repeatability, so there's industry skepticism. They won't go into the area thinking, okay, it's not going to work. So we understood the technical aspects of how carbonates, where they work and where they don't, and how they combine with mud rock, and that enabled us to see the value in Howard County, which is a high oil percentage county, lower gas rates, and shallow, so it's lower cost. So peers followed us. It wound up with large-scale development, highly, highly economic, partly because of those oil percentages. And we were able to do big inventory additions, not just ourselves, but also as an industry. And then we note further upside. So go to 2018, and in the western Eagle Ford play, so really Webb and Dimmitt counties, as of 2018, there were only 8 producing horizontal Austin Chalk wells, and they had $80 break-even prices. So the industry was ignoring it, saying, hey, it's not going to work over there. And that's what was estimated at the time. Our team collected a significant amount of geoscience data initially. That included coring the Austin Chalk and figuring out where to land wells. Our initial forays landed in one area. We wound up with economic wells, and then with further analysis, figured out a better landing zone, and that's when we really took off. That well hit in December of 2019, and it really showed us the ability to get high returns out of those Austin Chalk wells. So now fast forward to 2022, there's more, and this was at the end of 2022, over 113 industry horizontal wells, and we estimated 400 locations on our wells. Now at mid-2023, we've had over 85 of our own wells producing past their IP30s in the Austin Chalk, and we have 2 rigs running and 1 frac spread running on the Austin Chalk. So that's the story. So that when we talk about repeatable, that's what we're talking about. We can do this over and over again. We have history also in the Bakken and other plays earlier in our history, but this is the most recent. So looking forward, in the Midland Basin, just last quarter we acquired an additional 20,000 acres in Dawson County. And people say, well, isn't that where thermal maturity declines? Isn't it not going to work there? Well, if you've got the data, and there's a lot of vertical well penetrations there, and there's a considerable core data, and obviously log data from the vertical wells, we could see where the Dean was oil saturated and would work. And there's several wells in the area where you could see that, yes, these could be highly economic and competitive with our portfolio. So we did acquire those 20,000 acres. There's an additional 9,000 plus acres and continuing to grow that we're acquiring in the Midland Basin, and we've not disclosed the location of that. At some point we will once we have some well results there also. So overall we're at 111,000 net acres in the Permian Basin and Midland Basin, up from 82,000 a year ago. On the right side is showing our South Texas acreage, which we've had since really 2008 when we acquired that acreage. And the notable thing is we drilled 600 Eagle Ford wells, only to, in 2018-19, figured out that the shallower Austin Chalk worked. And then as I mentioned, we've had 85 wells in there. We also continue to drill a few Eagle Ford wells where it makes sense to co-develop with the Austin Chalk. I should mention that in the last quarter release, we also, and in late June, we announced that given the acreage acquisition in the Midland Basin that we were going to pick up a 4th rig, and that enables that growth that I'm talking about, that increase in the growth rate of the company into next year with that 4th rig running. We won't get wells producing from that one until next year, but the key thing is that we see the merits and the value of the wells we can drill there. So moving on, why are we excited about the Midland Basin? Well, this is where the technology really comes in. And you say, well, how does a company of 500 some people produce some of the best wells in the Midland Basin? So people say, well, surely it's going to be one of the super majors that does that. Well, the history of the industry. It's usually companies at the edge that outperform because they see something someone else doesn't. So on the left is really data from Enverus, and it shows that just in Howard County, we're outperforming our peers by about 31%. And why is that? And we're really focused on value, and that goes into the completion design. And I'm going to dig in a little bit more on what do we do on the completion design side that others don't, that enables that sort of outperformance. On the right is from Rystad, and this is the break-even prices, and this is for Midland Basin oil wells of several peers that are listed in the footnotes, which you probably can't read there anyway, but that's really a result of technology we've applied. So let me go on to the next slide. So this is one that looks confusing, but I think somebody else just mentioned GPT and AI. Well, we're not using ChatGPT to do this. It's but there is a lot of sophisticated analysis going into this. So I'm going to step back a minute, just historically. So I'm, on the older end of what our team is in doing this sort of work. In the late 1980s, I was working on a Cray computer, simulating Prudhoe Bay, and really working gas handling expansions and large projects to enhance the production from Prudhoe Bay. We drilled our first horizontal wells in the late 80s, and we were right at the cutting edge of the time. In 1990, we were fracking 750 millidarcy rock for Iraq to get oil production up at the time of the first Gulf War. So then now, when I look at what our team is able to do, it blows that away. It's just incredible what our team can do with the amount of data we have and the amount of simulation and the expertise, integrated geoscience, reservoir, and completion designs. So when we go through a design of an area before we choose the spacing or the well locations, specifically which intervals to drill in the stacked pay intervals in the Midland Basin, we've got 8 intervals we can drill. We choose what the spacing is, and we're simulating based on an extensively trained database. And what this shows here is completions capital on the bottom axis and the NPV, and it can be a well or a DSU, but in this case it's from the wells. So we have data from data trades plus our own wells, which is detailed. It includes the stage lengths, the cluster spacings, what the diameter of the clusters are, how they're spaced within a stage, all the way through the sand loading and the fluid loading, the traditional things you think about. So you combine the spacing design with the specific frac design, and we are able to simulate and say, okay, if we put 12 wells in this DSU, let's put a 13th well in pre-drill, simulated, what's the return on that 13th well? Add a 14th, what's the return on that? Where do we space it? And we got lots of different configurations. The 15th, and then we stop and we say, okay, let's say it's the 18th well and it's a 25% return on the incremental capital for that 18th well, call it $8 or $9 million. That has to meet that threshold. And that's how we're making sure we're capital efficient, and that drives the spacing design, and it's done for each DSU. So what this shows is what you'll see is we spend a little more on our completions, but we wind up with enormous value. And the rate of return from that orange cloud, which is where the peers have kind of homed in on, to where we are in the blue, it's a massive increase in rate of return. And that leads to the slide I showed before, that type of break even. So we're really optimizing technically to get to those designs. So I think I've probably gone on that long enough, but that's just so you understand how we differentiate ourselves from our peers on our acreage, which is really strong acreage. So what's that go to? This is looking at the Midland Basin inventory, and it excludes some of the largest Midland operators, so the 6 largest in the Midland Basin, then it looks at the next set. And Pier 1 and Pier 2 are large caps. Pier 3 is private, and then we're the 4th largest in terms of Midland Basin inventory remaining. People look at that and say, well, what about those? You got those low break-evens and the high break-evens. And remember, we're co-developing. So we don't see a deterioration year over year in our returns because we are already doing, say, 200% rate of return well with 260% rate of return wells on a pad. And that leads to us getting from each of the colors in that display on break-even prices. But it's a great result, and we continue to expand that, and we'll continue to expand that, identifying intervals that sometimes are overlooked by others. If I go on now to the Austin Chalk, it's a similar story. We had 10 new wells that reached their IP30 in the second quarter, and you'll see we're distributed where the stars are across our acreage. Average of 2330 BOE per day, 42% oil or 71% liquids. And because of the nature of going from the 4,000 foot level to the northwest down to the 8,000 foot level plus to the southeast, it's oilier to the northwest, gassier to the southeast. So you'll see we had on the right cumulative production. We had in this example in 22 and 23, we had 22 Austin Chalk wells in the liquids-rich gas area, which would be down towards the south, and 28 wells in the oily area. You guys know how revenues work, and so the rich gas wells generate more BOEs, but they're at lower revenues because they're NGLs and gas rich. And on the oil side, it's obviously got the revenues from the oil. So overall, the returns are similar between the two areas, and that's what we focus on. So you'll see differences in BOEs, but you have to be very aware of where it is located and how that would perform. But we've been super pleased with the Austin Chalk, and it's done super well for us. 85 wells already. So some people, when we first started drilling the Austin Chalk, said, "Hey, I know what that was like in the 1980s." And so I said, "Your father's old Austin Chalk vertical wells," and there were 17 wells that we saw in East Texas between 1981 and 2011, and 228 wells, and they had a P1090 of 17, and most of you know what P1090 means, just basically the ratio of the top 10% wells versus the top 90% wells. Then if you looked at the horizontal wells in the Austin Chalk, there were 3,644 drilled in the period 1988 to 2010, and that had a P1090 of 41. So people were naysaying the Austin Chalk, saying, "Hey, it's not repeatable. You're going to get a really great well, but it'll be followed by a number of weak wells." So what we're showing here with our well count of 85 now already, that per well, we have about a 3.4 P1090, and per lateral foot, it's about a 2.5. And that's very similar to the Permian. So the repeatability we've confirmed, and that's across a wide area. That's from the very oil-rich all the way through the liquids-rich gas. We expect 400 Austin Chalk locations. We've drilled 85, and we're not including the very dry gas Austin Chalk, which could be sometime in the future, but we're in no rush at drilling at about 30 of these a year. You can see we've got a lot of running room on the inventory side for the Austin Chalk, not to mention that we've got quite a bit of Eagle Ford down there also. So here's the story on the inventory. This one's from Enverus again, and you'll see that they see us as over 300 locations remaining, together with a couple other companies. One of those is over in the East Texas part of the play. So let me go on then to talk about the inventory overall. We expect over 60% average return at $65 a barrel with our total company inventory. So the whole inventory that we have, all those 10 to 13 years, are very high quality. One thing that gets confused, because of that customization we do on the DSUs, where we individually model each DSU and get the spacing customized, the landing zones customized, and in the case of the Permian, 8 intervals, and in the case of South Texas, 2 Austin Chalk landing intervals and 1 Eagle Ford. What you'll see is that if you try and compare inventory to peers, since there's no standard like proved reserves, if we change to an industry standard of 1,100 feet spacing per zone, you'd add about 4 to 5 years of inventory on that. Now, what we're doing is that incremental value assessment, and that's what drives it. So that's why we point out they're individually modeled, not just sticks on a map for doing that. So let me switch over to ESG for a minute. This is a big area of focus for us. We have set targets by 2030 for our reduction in emissions. We're really focused on that in terms of greenhouse gases and on methane. We were really pleased to find that Basin-wide Independent Methane Emissions Insights publication found us the number 2 for lowest methane intensity among Permian Basin operators. Here in the Mile High cities, since we had to pull this out since we're in Denver now, for 2023, we received the Social Impact Award, and that was really for companies that engage with Mile High United Way year-round to inspire employees to give, volunteer, advocate, and lead. And that's been a real source of pride for us and one of our core company values in giving back to communities where we live and work. So going on, if you want to find out more about what we're doing in the ESG area, we've updated our ESG disclosures for the year, and most of you know this, so we've reported to SASB. We've completed the CDP climate change questionnaire, and then the TCFD framework we mapped to the CDP questionnaire. That's all in our sustainability report, which you can find on our website. And with that, I think that's it, and I'll be able to talk to you from the breakout room coming up. And I think I actually gave you 2 minutes back, Mike.
Thank you.